Over the last 6 months, we've been highlighting the risks both globally and locally about inflation, the fact that central banks, including our own RBI, would have to increase interest rates, and the potential for stagflation, recession, particularly in Europe and also towards the US as well. And obviously with COVID restrictions in China, again, it's a country which is heading towards a very big slowdown, maybe not quite recession. So is this all priced in? Is the market anticipating it? Because, you know, the Nasdaq's down over 20%, it's in bear market territory. The S&P in the US is virtually in bear market territory. So has the market priced it in? We think we're getting there. Our only main concern over the next 3 to 4 months is as the Federal Reserve tightens liquidity through reduction in its balance sheet and increases interest rates, is the unintended consequences of this liquidity tightening. Because if you remember all of last year, 2021, every asset class rose because of the abundant liquidity. Now, when you tighten that, there's probably one asset class out there where there's going to be a problem. So all of those problems which were hidden under the carpet might be swept out from under. So that's one of the things that we're just worried about. But if that doesn't play out, we do feel that, you know, by the kind of third quarter, the Fed will probably be likely done in its interest rate kind of increases, because the economy will be heading towards either a very big slowdown or recession, because it's all about demand destruction. That's what the Fed's talking about, and other central banks, is reduce the aggregate demand. So if you reduce aggregate demand, the supply chains will start easing more and commodity prices will fall. So therefore, you will have, in our belief, at the back end of the year, people talking more about deflation, not inflation. Therefore, interest rates will come down. So towards the second half of the year, you shouldn't be looking at the inflation trade, you should be looking at the deflation trade. And of course, banking would be one of the big plays for that.